One of the things that we definitely have to keep in mind is, what does today's follow through mean to next week? So today's video is going to be all about setting ourselves up for success next week. This is a challenging week. Everything from a more hawkish Powell on Tuesday to the XLF meltdown impacting the Dow, impacting the S&P. It seems that looking at strength in bonds, obviously, we'll talk about the reasons there. Looking for lower yields, we'll talk about where we can trade and gauge that. And ultimately, what it is we want to do in terms of time frames and how to be more nimble in this environment without necessarily having to day trade, but being open to both short-term swings and day trading. For those of you that don't know me, I'm Raghee Horner. I'm the lead trader over in the Simpler Futures room, as well as the Sector Secrets Mastery. And what we're going to do today is do a really good thorough breakdown of a session that I do every Friday called the Ask Me Anything. What I'm sharing with you are the notes that I post for members in the room when I do any session. This is the Ask Me Anything notes. We're going to go through what it is that we discussed and what it can mean for us next week. Apart from the big move on ZB today, so this is the long bond, TLT long bond. This started off as a day trade, and it's probably a really good sort of touchstone for what we want to do next week. So from this morning's day trading the open, what we did is we went ahead and got long either the June contract of ZB or the 17 March or 10 March 104 calls. Now, why the difference? Well, if I want to just make it a day trade and keep costs low, I'd go with the March 10 expiration, less expensive. But if I wanted to turn into a short-term swing, right, I could go with the 104 call for 17 March. Now, there's no right or wrong here, but the idea that we're able to take it past today's expiration into next week makes a lot of sense when we consider what's happening with yields. They are dropping. Now, the reason for the yields dropping, let's talk about this here. If I'm looking at yields, first of all, we have a less hawkish view, meaning possibly a lower terminal rate than we had on Tuesday when Powell said they're going to stay pretty darn hawkish. The Fed may peak, according to Fed Fund Futures now, at 5.25% to 5.5%, or 525 to 550 basis points. What does that mean, right? And why do we care? That means that is 1/4 to 1/2 point less than what was factored in on Tuesday. That means that the Fed's going to likely stop in June, and 1/4 to 1/2 point lower on that terminal rate than we thought during the opening remarks of day one of the Humphrey Hawkins testimony. In and of itself, lower yields are bullish to stocks. However, there's two narratives, right? This lower yield narrative does not get to operate in a bubble. The other opinion is the Federal Reserve has hiked the economy right into recession, which if you talk to any business owner, if you talk, I've got friends in real estate development, and so they'll say, hey, Rog, we've been in a recession, right? So there's the reality we live in, and then there's the reality of the Federal Reserve. We trade the latter, gang, right? We just trade their reality because they're the ones at the helm of the levers and dials of the economy via interest rates and printing money. So if that's one view, the other view is simply that bonds are moving higher because of the fear. The other part is, hey, bonds are simply moving higher because the Federal Reserve's not going to hike as high. I think the recession concern is probably going to be exacerbated by, obviously, what happened in financials. And the fact that, here's the disconnect that tells us this is maybe more of a panic sell-off. The fact that yields are lower while indices are moving lower as well. So that's not usually the way we see things. Yields moving lower tend to give traders a reason for risk appetite, and they'll buy the indices. Yes? So we want to stick with things like long bond, long 10-year. If you take a look at HYG, JNK, these are other ways to look at yields in addition to the Fed Fund Futures, right? Which again are indicating the Fed's probably going to peak a little bit lower. And why would they? Why do we have this optimism in terms of lower yields, right? Specifically that, because while the headline number for non-farm payroll at 311,000 was a big number compared to expectations, average hourly wages were down 1/10 from expectations, and the unemployment rate was up 2/10. That tempers that big jobs number, right? But overall, this is certainly still a fear-based environment, and the place of the most resilience is tech. So there's two things that I want to focus on for next week. Let's go to the top of the notes here. And if you want to pause this and read the notes at any time, I mean, feel free. The level of support that I want to keep an eye on next week in the NASDAQ is going to be right around that 11,832.5 level. That's this Darvas level, the automated support and resistance of the Darvas 2.0. XLK and Apple are actually relative outperformers to the NAS, well above the Darvas. Apple is actually still in a pretty healthy uptrend overall. So that you have a relative performance look at Apple. If you're looking for strength, keep an eye on Apple. It's still above the 200 propulsion. Healthcare and financials are going to drag on the S&P and the Dow, so I'm going to leave them alone, or I'm going to simply take advantage of them slightly shorter term. Short-term swings can easily be done on a 1-hour time frame, kind of the way we talked about for ZB and TLT. So if I want to be a bear, if I want to take advantage of weakness, the best way to do that, and this is what I'm going to be doing going into next week, I'm going to use a 5-minute for day trading like I do the first hour of the day, and I'm going to look for 1-hour short-term swing trading. If that's to the long side, maybe in something like Apple, or if that's the short side in something like the S&P, the Dow, healthcare, financials, so be it, right? We can be more nimble on that 1 hour. We can take positions overnight as well on that 1 hour, but we're not going to have to expect, maybe a week or more follow through on that shorter term time frame. I think that shortening of the time frame, not necessarily day trading unless you want to, but the 1 hour time frame with the DPMRs is going to be how I'm going to manage this coming at least Monday, Tuesday, Wednesday. And you can see on the S&P on the 1 hour, this is what we're talking about. Trend is down, we take advantage of a short and resistance. Trend is down, we take advantage of a short and resistance. That was Thursday and Friday, right? And then if we look at the opposite side of that, the bond rally, trend is up, and whether you want to take advantage of an oversold slow stochastic down here near the low in a neutral environment, whether you're waiting for the DPMRs, it still makes sense to look to the long side in bonds, and we'll just stair step these DPMRs along the way. What about something like Apple, right? If I can get a little bit more weakness out of Apple, if we see some weakness into the Monday open, 147.65 on Apple, or even a little bit more conservatively, we'll take advantage of the DPMRs on Monday and take advantage of those volatility-based support levels. So this is what I've got going into the weekend. I think the best adjustment we can make is a focus on long bonds, long notes, and then also a focus on tech, SMH, XLK, XLC, names like Meta, right? So find things related to the NASDAQ, but maybe relative outperformers. And that's going to make a lot of sense. Meta's been a fantastic relative outperformer throughout the week, and we might look for an opportunity come Monday for an oversold Meta play to the upside. We don't have to play bullish. Just remember, if you want to play bearish, long from lower, but short from higher. And that's exactly how we'll go into next week. All right, gang. I will see you all in the next update. And for those of you that are joining me for tomorrow's DPMR Masterclass, I'm looking forward to seeing you 1 o'clock. All right, gang. Until then. Hey, traders. Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.